Okay, so you want to own a private hospital. You've done the math, and the math looks extraordinary. Healthcare is the one industry where demand is guaranteed, where customers cannot shop around when they truly need you, where insurance companies and governments write checks that would make any other business owner dizzy, and where the word elective has been quietly redefined to include procedures that people will take out second mortgages to afford, because the alternative is pain, and the alternative is waiting, and the alternative is the public system, where the waiting list for that procedure is 14 months, and your knees hurt every single morning when you get out of bed. You make the call. And the first thing you discover is that owning a private hospital is nothing like owning any other business you have ever run. Because in every other business, the customer chooses whether to need your product. In healthcare, they don't get that choice. Which sounds like an advantage until you understand that every person who walks through your doors comes with a complexity. Medical, financial, legal, emotional, regulatory, that no other customer in any other industry brings with them. And that complexity has a cost. A very large, very persistent, very unpredictable cost that sits underneath the extraordinary revenue numbers like a fault line under a beautiful building. Let's start with what you are actually buying. A small private hospital, 50 to 100 beds, a handful of operating theaters, standard diagnostic equipment, emergency capability, costs somewhere between $50 and $200 million to build from scratch, depending on location and specification. A mid-sized facility with genuine surgical capability, an ICU, imaging equipment, and the kind of hotel-standard patient rooms that the private market increasingly demands costs between $200 million and $1 billion. The equipment alone is staggering. A single MRI machine costs between $1 and $3 million. A CT scanner between $500,000 and $2 million. A surgical robot, the kind that allows minimally invasive procedures that patients now expect as standard, costs somewhere between $1 and $2 million, plus annual service contracts that run into hundreds of thousands. A cardiac catheterization lab costs between $3 and $6 million to fit out. A neonatal intensive care unit requires specialized equipment that costs millions before a single baby has been admitted. And all of it depreciates. All of it requires maintenance. All of it becomes obsolete faster than you expect and needs replacing on a schedule that your finance director will remind you about at every board meeting for the rest of your ownership. Now let's talk about what generates the revenue. The operating theater is the engine of the entire business. Everything else, the beds, the diagnostic equipment, the pharmacy, the restaurant quality catering, supports the theater. Because the theater is where the procedures happen, and the procedures are where the money is. A hip replacement generates somewhere between $15,000 and $30,000 in revenue in the UK private market. A cardiac bypass generates $50,000 to $100,000. A spinal fusion, somewhere between $20,000 and $60,000. A routine laparoscopic procedure, keyhole surgery for something relatively straightforward, generates between $5,000 and $15,000. And these procedures take between 1 and 4 hours. A busy theater running 2 sessions a day, 5 days a week, 50 weeks a year, with a full complement of surgical lists across multiple specialties, generates an extraordinary amount of revenue from a single room with good lighting and very expensive equipment. But here is what that theater actually costs to run. The surgeons, they do not work for you. In private healthcare, in most markets, the surgeons are independent practitioners who bring their patients to your facility and pay you a facility fee for the privilege, or who work on a sessions basis where they perform a certain number of operating lists per week in exchange for a fee. You provide the theater, the anesthetist, the nursing staff, the equipment, the sterile supplies, the post-operative care, and the bed.
They provide the technical skill that the patient is actually paying for. This relationship is the central economic tension of private hospital ownership. The surgeon is your most important supplier and your most important customer simultaneously. Without their patient list, your theater sits empty. But the surgeon knows this and prices their cooperation accordingly. They can move their patients to a competitor facility if you reduce their sessions, if your theater runs late too often, if your nursing staff turns over too fast, if your equipment is outdated, if your car park is full, if the coffee in the consultant's lounge is bad. The surgeons will leave over the coffee. This sounds like a joke. It is not a joke. Your nursing staff is the next problem. Registered nurses are among the most persistently in-demand workers in every developed economy.
The shortage is structural, global, and getting worse as populations age and the existing nursing workforce ages with them. Agency nursing, hiring temporary staff to fill gaps, costs somewhere between 2 and 3 times the cost of a permanent employee and delivers inconsistent quality that affects both patient outcomes and the surgeon relationships you are desperately trying to maintain. Your nursing wage bill in a mid-sized private hospital runs between 30 and 50% of your total revenue. On a facility generating $100 million annually, that is $30 to $50 million in staff costs before you have paid a single doctor, purchased a single surgical supply, or made a single loan repayment on the building. Now let's talk about the insurance companies, because in private healthcare, the insurance companies are not your customers. They are your most powerful and most adversarial business partners. The patient who walks through your door has private health insurance. They believe their insurance will cover their treatment. What they do not know, what most patients discover only at the worst possible moment, is that their insurer and your hospital have been engaged in a pricing negotiation that determines exactly how much of their treatment the insurer will actually pay for. Insurers negotiate rates with hospitals. They set fees for every procedure, every bed night, every diagnostic test, every pharmaceutical dispensed from your pharmacy. Those negotiated rates are almost always below your listed prices, sometimes significantly below. And if your hospital has not negotiated a contract with a particular insurer, or if the contract has lapsed, or if the procedure falls outside the contracted terms, the insurer will decline to pay, and the patient will receive a bill that neither they nor their surgeon anticipated. This is the source of more complaints, more legal disputes, more reputational damage, and more regulatory scrutiny in private healthcare than almost any other single issue. Not the surgery, the bill. The billing department in a private hospital is not a back-office administrative function. It is a revenue-critical operation that requires people who understand insurance coding, procedure classification, appeals processes, and the specific contractual terms of dozens of different insurance agreements simultaneously. Getting this wrong does not just mean delayed payment. It means unrecoverable revenue, patient complaints, and in some jurisdictions, regulatory investigation. Now, let's talk about the thing that makes private healthcare unlike every other business in terms of its liability exposure. Things go wrong. Surgery is not manufacturing. It is not a process you can standardize to the point where the output is consistent every time. Human bodies are complicated. Complications occur in the best hospitals with the best surgeons using the best equipment. Infections happen. Anesthetic reactions happen. Blood clots happen. Wrong site surgeries happen. Retained surgical instruments happen. And the stories of what has been found in patients during subsequent procedures would make you understand immediately why your medical malpractice insurance premium is the number it is. Medical malpractice claims in private healthcare are expensive, slow, and reputationally damaging in ways that other business litigation is not. A patient who was harmed during a procedure at your facility is not an unhappy customer who can be offered a refund. They are a person whose life has been affected in ways that may be permanent.
whose legal representation is working on contingency and therefore highly motivated, and whose case will be heard by a jury that has been carefully selected for its sympathy toward patients and its skepticism toward corporations that make money from sick people. Your insurance covers the financial liability. It does not cover the years of litigation, the management time consumed, the staff morale affected by the process, or the Google reviews that appear the morning after a negative story runs in the local newspaper. And then there is the regulator. Private hospitals in every developed market operate under a regulatory framework that is comprehensive, mandatory, and enforced with consequences that range from required improvement notices to immediate closure.
In the UK, the Care Quality Commission inspects registered providers against detailed standards covering safety, effectiveness, caring, responsiveness, and leadership. In the United States, the Joint Commission accredits hospitals against standards that run to thousands of pages. In Australia, the Australian Council on Healthcare Standards performs similar functions. A failed inspection does not just mean a fine. It means a published report that your competitors will share, your patients will read, and your insurance company will note when your renewal comes around. In the worst cases, it means mandatory closure of specific services or the entire facility while improvements are made, during which time your fixed costs continue and your revenue stops. You have spent $200 million building this facility, and the regulator can shut your operating theaters on a Tuesday afternoon because a nurse did not document a medication administration correctly in the required format. This is the industry. So where does a well-run private hospital actually make money?
The specialties with the best economics are elective surgery with short procedure times and high volumes, orthopedics, ophthalmology, dermatology, plastic surgery. A cataract procedure takes 15 minutes and generates between $2,000 and $4,000. A theater running cataract lists can process 20 patients in a day. That is $40,000 to $80,000 in revenue from a single theater in a single day, from a procedure so standardized that complication rates are measured in fractions of a percent. Weight loss surgery, cancer treatment delivered through day case chemotherapy and immunotherapy infusion suites, fertility treatment, IVF, which is not covered by most insurance policies and is therefore paid in full by patients who will spend whatever is required because the alternative is not having children. These are the revenue streams that fund everything else. The economics of a well-run, mid-sized private hospital in a wealthy market, London, Sydney, Dubai, Singapore, New York, look something like this. Annual revenue between $100 and $300 million. Operating costs between 70 and 85% of revenue after staff, supplies, insurance, maintenance, and regulatory compliance. Net operating margin somewhere between 15 and 30% in a good year on a well-managed facility. That is real money. But the capital required to generate it, the complexity of the operation, the liability exposure, the regulatory burden, and the staffing challenges make it one